Hello, everybody. Welcome to the webinar, How to Review a Tax Return as a Retirement Planner. We will give it a couple more minutes here, let some other folks trickle in. Thank you all for joining me. Cody Garrett says hello. Hold on. Hi, Cody, in small caps. Thank you all. So yeah, today I'll get into more details, but just again, give another minute or so here. Today will be how to review a tax return from a retirement planning perspective. Now, this information and things we'll be looking at today won't only be in relevance to specifically retirees or those near retirement, but it's some of the things that commonly come up in reviewing a tax return for people who are retired or close to it. And the intention is you as a financial advisor / planner focused on working with retirees or people close to it. You should hopefully get a lot from this, whether or not you already do some tax return review or tax planning. Regardless, I'm pretty confident you'll find some pretty cool stuff here. I do have a packet, a handout that I'll email to you all afterward. I promise no solicitation. I did not add any of your emails to a distribution list, but as a means of distributing the info we're going over today, I will email it to you all after. Feel free to deal with it as you please. I will have it up on screen. It's a single PDF of the things I'll be going through. So you'll get all this stuff afterward. Okay, let's see, 2 o'clock. Let me just see the other Q&A here. Cool. All right, let me get started. Now I will do screen share. The way I'm thinking of doing this is my first time doing a webinar. I am not in the business of doing these paid webinars geared towards other advisors. This is me doing it simply because I genuinely enjoy this stuff. I enjoy teaching and educating, and I do it in practice. I realize a lot of advisors don't do much tax planning, if any, and it's a relatively new value add that's getting folded into the service mix for a lot of advisors. So I thought it'd be helpful if I can show you at least what I go through, what I do, and hopefully everyone here gets a little something out of it. So without further ado, let me pull up and save questions till the end. I'm thinking I'll do approximately, I don't know, let's say 40 minutes. Sometimes I have a tendency to kind of get long-winded, so I'll try to limit myself, but we'll do about 40 minutes, let's assume, and then I'll leave it open for Q&A. So if you do have questions, please hold it till the end. Otherwise, it's gonna chop up the flow a little too much here. All right, let me pull up the screen here. All right, hopefully you all can see this. Again, everything you're about to see now, I will email to everyone in attendance after the fact. As far as replays of this video, they will be available on my YouTube channel, which is publicly available to the world. I'll post the video up, and it's raw, uncut glory for everyone to see. So this is the packet you'll get. Again, just a quick cover sheet, a little bit about me for those of you who are like, who's this character in front of me trying to tell me about tax returns. So I am Andy Panko. I am the owner of Tenon Financial, which is a fee-only retirement planning investment management firm based here in Metuchen, New Jersey. It is a largely virtual firm. I have 2 New Jersey clients. Otherwise, everyone else is scattered throughout the country. I'm also have a tax return preparation company called Tenon Tax Preparation. My career prior, from 2000 to 2019, was in various corporate and institutional banking, investment and risk management roles at some of the major insurers and global investment banks. I'm also a part-time lecturer for Rutgers Business School since 2010. I've taught. I'm currently teaching now. This is my 6th semester as an adjunct, if you want to call it that. I have the CFP, RSCP, and MN, and that sounds weird, and MN IRS enrolled agent. I went to Rutgers University for my MBA in 2004 and University of Delaware for my undergrad in 2000. So social media and educational stuff. Here's links. Again, you'll have access to this file after the fact where you all can see this. For today, I will be referencing some of the things here. I have a bunch of free resources on my business website, and all these things are free to download without any lead capture. You don't have to put up your name or email or anything. Let me just show you what that looks like quickly. And the reason why I bring it up is not just to pitch this stuff, but because I will be making reference to some of it. So let me stop my screen share real quick here. Alrighty, sorry. Yeah, cool, okay. So you all should be able to see this. When you click on that link, tenonfinancial.com/free-resources, there's a whole host of stuff. Part of it is just me making reference to my podcasts and social stuff. But scroll down a little bit, you'll see there's a Roth IRA withdrawal rule summary. For today, I will be referencing this. I put together a summary that hits on some of the main MAGIs, or modified adjusted gross incomes, that commonly come into play with retirement planning. So you'll see some of these things referenced in the tax return we'll be going over. So if you're interested, you can click this, download this. I'll also be referencing this. This is one of those annual updated important numbers thing. This particular one's from College of Financial Planning, has the tax brackets and rates, has the Medicare surcharge income thresholds, has HSA things, retirement contribution limits, et cetera. Freely available. I didn't make this, College for Financial Planning, but freely available on my website. And there we have it. Okay. So let me now go back to the other. All right, we'll get into it now. All right. So that's the free resources. For those of you that want to follow along, again, I'll be doing this largely from this PDF I'll have up on the screen. And also, again, please hold questions till the end. I'm figuring about 40 minutes. So let me start with the all-important disclaimer. All right. Disclaimer, this webinar is only general explanations and education. It is not specific tax, legal, investment advice. While I believe all information presented to be accurate, I make no representation of the same. Neither I nor Tenet Financial LLC shall be held responsible for any damages or losses relating to your use of the information presented herein. Thank you! Exclamation point. Okay, so let's now get into it. Here is a sample tax return. Again, this is focused on retirees or people near retirement, but some of these things will be unique, will apply to everyone, aren't unique to retirees. Also, I'll be making some comments of things you can keep in mind when reviewing a return of a prospective client. Also, some things you can keep in mind when reviewing tax return of an actual client. The difference is, hopefully, with an actual client, you shouldn't be surprised by what you see in their tax return. With a prospect, assuming you don't know much about them, some things may jump out where you can have a value add to recommend to them. Hey, I noticed this, maybe XYZ, in which case they may like it and say, cool, let's be a client, or they may say, thank you very much, and walk away and never see you again. So anyway, so some of this stuff will be for prospects, some of this will be for clients. So just kind of starting at the top, let me cut ahead briefly. So I do have the full tax return here I put together, but at the end of the handout you'll all get, excuse my screen scrolling, I have 7 pages of notes. This is largely what I'm going over today. This was me as I sat down a handful of days ago, going through the tax return. I just sort of spit out onto paper the things my brain was thinking and looking at and considering as I was going through this tax return that I put together. So most of what I'm saying today will be in these notes at the bottom. Again, 7 pages, some of which are actionable planning opportunities, things I highlighted, underlined, are things that I thought, this is worth mentioning because it's either common or it's a good opportunity or something like that. So feel free to use this as much or as little as you want. Again, you all will get a copy of this whole packet at the end. So I'm just going to kind of verbally walk through this stuff now. Going back up to the top. Hope you don't get nauseous from me scrolling so much. So here we have it. Starting at the top, to kind of walk through. This is 2021. 2022 may look slightly different. The IRS does often change some of the content in these things and the numbering of the rows, but largely they generally seem to look or usually look not too different from this. Starting at the top, filing status. It kind of is what it is. Some things to keep in mind for married couples. They will rarely be better off filing separately. Almost always, they're better filing jointly. And by better, I mean from what produces the lowest income tax. Now, states may be different. Today's presentation is about the federal return, unless I mention otherwise. Each state that has income tax has its own unique twist and turns. So depends. Maybe they're better filing separately at the state level. Maybe that would sort of force their hand in filing separate at the federal level, but let's assume not. So generally, married folks will be better filing jointly. For married couples, when one spouse passes, the surviving spouse can still claim as married joint for the rest of that year. Whether the spouse died January 1st, December 31st, or any date in between, the surviving spouse can file married filing jointly for that whole year. So there's an opportunity, because after that year, they'll have to file single unless they remarry. And once they do single, their tax situation is going to worsen because brackets are smaller. So all else equal, they'll be hit with higher income tax as a single person than they will married. So not that a recently widowed person's top of mind thing is tax planning and tax optimization, but food for thought. It's the last year of comparatively large tax brackets. That last year being married, in the year of death versus the next year, the tax brackets are going to collapse when they become single. For single folks, they usually have to be single unless there's also head of household or qualifying widow or widower. I won't get into those much here. They often don't apply to retirees, but head of household basically means you have a dependent child or dependent relative. You provide at least half of his or her support and generally have to live with you throughout the year. Qualifying widow or widower is when a married couple, when one spouse dies, the surviving spouse has a child, a dependent child still living with him or her. You can file as qualifying widower for a couple of years, and that gives more preferential tax rates than filing single. So that's filing status. Names, I mean, this whole descriptive box here is really just static data, names, social security numbers, address, etc. Not much to see or do here, unless you happen to notice, like in reviewing their tax return, hey, wait a second, this social doesn't jive with what I know it to be. Otherwise, this information is what it is. This next line here is new, relatively new. It asks, did the taxpayer receive, sell, or otherwise dispose of any crypto or virtual currency during the year? This is a big one. The IRS is starting to crack down, starting to try to get people to report. A lot of people with crypto transactions don't report, either because they don't know they have to, or they're intentionally trying to dodge taxes on it. The IRS is starting to pay more attention. So if you happen to know a client of yours has, or not has, but traded any sort of virtual currency during the year, make sure this question is answered properly. Standard deduction. If the person is a dependent of someone else, then check it. This usually won't apply for married folks, for typical retirees, but nonetheless it can impact our standard deduction. This age and blindness question. This matters because if you're 65 or older and or blind or disabled, there's additional standard deduction that applies for the taxpayer. So if again you're reviewing a tax return for a couple or an individual, one of these apply, make sure they're checked because it can lead to a higher standard deduction. This could be hopefully not an easy miss or not a common miss. I mean, tax return software should automatically populate that, assuming the tax return preparer has the client's proper info in it. If the client has dependents, again, retirees, they generally won't, but if they did, they'd be listed here. Pay attention, if there are dependents, some things may apply, like other additional credits, child tax credit or credit for other dependents. So if you see these, dig in a little more. Otherwise, you may not notice these filled out on a typical retiree tax return. All right, get into the meat and potatoes. Line 1, wages. I left it blank in my hypothetical example here of George and Wheezy Jefferson. Yes, moving on up. I assume they're already retired, so there's no wages. If there are wages, there's a lot of possible opportunities you can possibly parse out from this. For example, they're employed. Do they have an employer savings plan? Is there a company match? If so, is the client taking full advantage of it? Is there a Roth option, contribution option to the savings plan, as opposed to traditional pre-tax? If so, could they benefit from that and take advantage of that? Do they have an HSA? Something kind of cool for people nearing retirement. You can cobble together what the client's health insurance COBRA premiums will be by looking at a combination of their last pay stub of the year and their W-2, because the W-2 will show how much healthcare premium contributions were made by the employer. So add that plus the employee's out-of-pocket premium expenses during the year, and boom, there you have it. That's the total premium plus 2 or 3%. They'd have to pay in COBRA if they were to retire and choose to extend their employee-sponsored retirement benefits through COBRA. So that's planning opportunity. When clients are trying to figure out what do I do for healthcare, assuming they retire before 65. What are my options? Well, COBRA is an option if they have employee-sponsored coverage, and you can help them figure out what that cost will be, so they don't have to go to their employer and ask what's the cost going to be, because that may sort of set off bells like, why are you asking? You plan on retiring? So maybe the taxpayer is not confident asking that info of their employer, so you can help figure it out for them. Moving on, line 2, tax-exempt interest and taxable interest. Here's a common error, especially for those that live in states that do have income tax. Line 2A shows tax-exempt interest. That's things from like municipal bond interest when the bonds are held in the client's regular taxable brokerage account. Why is this a common problem? Well, it's tax-free at the federal level, and if the issuer of the municipal securities is in the same state as the client, it should also be tax-free at the state level. I've seen a handful of times where a tax return preparer misses this and doesn't accidentally or otherwise, doesn't exclude the municipal bond interest from their state return when they should. Now, a lot of times this won't be a big difference. It'd be tens of dollars of tax, but I did catch one earlier this year where it was $600 of state tax that it saved the person by, spotting this error. And just side note, when you do review tax returns, you're not the one who prepares it. Don't be a jerk about it. Mistakes happen. Tax returns are bound to have errors. There's a lot of moving parts, a lot of manual entry. There's a lot of numbers. Even the best of tax return preparers do occasionally make mistakes. So if you do find something, don't thump your chest and go to the person's tax return preparer like, hey, jerky, you caught this, you're sloppy. Now, if the tax return preparer consistently makes errors, that's a different story. But you find an error, don't think you're a champion of the world. Point it out to the client, do it professionally, do it tactfully, and discuss with them the pros and cons and costs of perhaps them getting their return amended to fix it. Depending what the error is, the tax return preparer may cover the expense of the amendment, or if it's something that was the client's fault, the tax return preparer will charge them for the amendment. So do the dollars and cents analysis to see if it's worth bringing up. And then taxable interest on 2B, that's things like interest from regular bonds in corporate account, brokerage accounts, interest from bank accounts, et cetera. One thing, hold that thought, I'll get to Schedule B later. You can use this to help figure out maybe is a client holding too much cash. For example, they had $7,000+ of interest last year. Let's assume it was on a savings account at average rates of like 1% interest last year. That's a lot. Client had, hundreds of thousands of dollars in cash last year. That could be a planning opportunity. If this wasn't already your client, you can spot this and be like, hey, this person has, this prospect has a lot of cash. Maybe we can discuss that. All right, so hold that thought. I'll touch on that more in Schedule B. Qualified dividends, ordinary dividends, line 3A and B. Qualified dividends, there's more to it than this, but suffice it to say, any U.S. stock that pays dividends, chances are it's qualified. There's more to it than that, but let's leave it at that. And then other dividends, non-qualified, will be everything else. So if you happen to notice, for example, the client has a lot of dividends and most of them are not qualified, that could be a planning opportunity. Look into their portfolio, find out, hey, why is so much of your dividends not qualified? Why does it matter? Qualified dividends are taxed at a lower rate than ordinary or non-qualified dividends. So you can save the client some tax by potentially rejiggering, reinvesting their portfolio to dividend stocks that do pay qualified dividends. Now, as always, anytime you anticipate or plan on doing investment changes in a taxable account, you got to pay attention to the tax implications of, realized gains or losses. I'll touch on that in a bit. You can't just willy-nilly rebalance a regular brokerage account because it may bring some unwanted tax ramifications. Next, IRA distributions. So the gross amount of distributions will be in 4A. The taxable amount will be in 4B. If you ever see, let's say from a prospect perspective, if you ever see the gross amount is larger than the taxable amount, that should pique your interest that, hey, there's probably some basis, some after-tax money somewhere in one of the client's IRAs, in which case that's good to know. That could help for future planning and in doing like analysis about conversions or other IRA distributions, how much of it may be taxable, how much may not, based on the calculation of pro rata. Because if you do have any after-tax quote unquote basis in IRAs, every dollar you take out or convert, every dollar you distribute or convert from any of your IRAs will be subject to proration, where every dollar out will be partial return of your after-tax basis, and the rest will be fully taxable. Form 8606 is what does that calculation. I do have an example of it attached here that I'll touch on in a bit. Line 5, pensions and annuities. This all depends. Do they have a pension? Do they have an annuity that they got money from during the year? If not, this will be blank. But in my example here, I assumed that they cashed out a non-qualified annuity that was worth $110,000, $100,000 of which was their contribution, which means only $10,000 of it is taxable. Hence, 110 gross distribution, 10,000 taxable. Why'd I put this here? I don't know. Just to have something to say about if you see anything show up on these lines, the person has a pension and or an annuity. So dig in, see if there's any planning opportunities around it or et cetera. Social Security benefits, the gross amount will be shown on 6A, and that's gross before any Medicare premium deductions or tax withholdings, for example. The taxable amount of that will be on 6B. As you all probably know, up to or no more than 85% of gross Social Security benefits are taxable. It could be zero, as low as zero. And it all depends on, not to get too off track, but the client's quote unquote provisional income. And I do have this spelled out in the notes at the end that you'll all get. This can be a whole topic in and of itself, but for purposes of today, just know that all else equal, the more income the client has, the more of their Social Security will be taxable, up to 85% of it being fully taxable. Planning opportunity. In my example, whether this is, let's assume this is a prospect, perhaps they come to me, they show me their tax return, and I say, okay, they're taking Social Security. At least one of them is, but I know they're only 63. So clearly, one of them started Social Security early, right? Now here's an opportunity. Maybe dig in. Maybe would they benefit from undoing it? You can undo your benefits within 12 months of starting it, or if you're past that 12-month point, once you hit your full retirement age, you can quote unquote suspend your benefit. So it'll start growing again from delayed retirement credits. So there's a little more insight you can glean on these folks here. Maybe I'll bring up to them, hey, do the analysis. Perhaps it's worth undoing or eventually suspending your benefit, Social Security benefit. Capital gains and losses. This is all activity in a regular taxable brokerage account. You sell something at a realized gain, realized loss is going to show up here. Another biggie. This was a big one last year, 2021. Capital gain distributions from mutual funds held in regular taxable brokerage accounts. Long story, but a lot of clients got really zonked with unwelcomed and unexpected large capital gain distributions passed through to them on mutual funds held in their regular brokerage accounts. Now, these aren't capital gains from them intentionally selling out of any of the position. It's just the underlying sales within the fund done by the fund manager. Any gains they generated by law need to be passed out to the fund holders. So a lot of clients got hit with big surprise capital gain distributions last year, taxable capital gain distributions. Generally, there will be a Schedule D attached, as I'll show, showing or summarizing the capital gains and losses. If there's not, if you just see a number here and there's no Schedule D attached, chances are that's simply from capital gain distributions from their mutual funds. If that's the only source of capital gain, there does not need to be a Schedule D attached. Another opportunity, if you happen to see a loss, so if a client has a net capital loss for the year, they can deduct up to $3,000 of that against their other income, or $1,500 if they're married filing separately. But let's assume it's $3,000. If you happen to see exactly $3,000 of realized capital loss, chances are more where that came from. Meaning you can only deduct up to $3,000. If they had more than $3,000 loss for the year, the remainder above and beyond $3,000 will be carried forward to future years until it's eventually absorbed. So planning opportunity. If you see negative $3,000 here, chances are there's some unrealized loss that's carrying over. That's something you can possibly soak up and harvest, such as if the client wants to sell out of other things at a gain, you have some of that loss to help soak it up. Other income, there's a lot that can possibly go into here. You'll see in the notes, for example, if you have business income, rental income. In this case, I'm assuming some rental income. But if you have gambling income, you need to report that. You can also deduct gambling losses up to the amount of gambling income for a given year. Or if you see like a taxable distribution from a health savings account, that's an opportunity to look into it. Maybe did someone mess up, right? HSA's distributions are tax-free if they're used to pay or reimburse qualified medical expenses. If you do ever see a taxable HSA distribution, either tax preparer messed up, or maybe the client did take money out when they shouldn't have, but something worth looking into. Anyway, so that's line 8. There's a lot of stuff that goes in here, or could go into here. In this example, I'm showing some rental income, which I'll hit on in a moment. And then line 9, this just simply sums up everything above. Easy enough. Adjustments, line 10. In addition to Schedule 1 showing a bunch of other areas of income, there's also some areas of deduction or adjustments that may reduce the amount of income that's otherwise taxable. For example, educator expenses. If you're a teacher and you have some out-of-pocket expenses for the year, you can deduct some of those. Health savings account. If you do make deductible contributions to a health savings account, that's where they'll show up here in the Schedule 1. Self-employed health insurance for those who do happen to be self-employed. Like some retirees pick up a side hustle and they can potentially deduct the premiums they pay for health insurance. Medicare applies. If you're over 65, you're on Medicare, you get bored, you decide to go back to work, start a small consulting business. You can potentially deduct your Medicare premiums as a self-employed health insurance expense. Fun fact, if you're married, you can also possibly deduct your spouse's Medicare premiums, even if your spouse is not at all engaged in your business, in your side hustle. So there's a real good possible planning opportunity that's often overlooked for self-employed people who are on Medicare. So after subtracting out these deductions from line 10, you're now left with line 11, adjusted gross income. This is a biggie. This is a big fat one. Pay attention to this. This not only is important because it eventually flows into the amount of income that's taxable, it feeds lots of other things throughout the tax code. For retirees, for example, the people who are early retirees, not yet 65 and unable to be on Medicare, it impacts the amount of subsidies they're able to get if they enroll in Affordable Care Act insurance, aka Obamacare, aka through the exchange. If they are 63 or older and going to be starting Medicare when they're 65, or they're already on Medicare, this also feeds into the amount of surcharges they may have to pay, if any, on their Medicare premiums, something called IRMA, Income Related Monthly Adjustment Amount. To see these thresholds, you can go to that free resources section I referenced before on that College for Financial Planning free info download. It has all the various Medicare income levels where these Medicare surcharges start to kick in. So if you see, sorry, just looking at some comments here. Okay. If you happen to see the client is close, their AGI is bumping up against one of the thresholds that you're aware of for things like Affordable Care Act premiums or Medicare surcharges, even ability to contribute to a Roth IRA if they're still working, pay attention. Maybe you can help them manage, massage, reduce, increase their income perhaps to stay below certain thresholds. Again, check out that link on the free resources for the different MAGI and modified adjusted gross income summaries. MAGI stands for modified adjusted gross income. It starts with your adjusted gross income, which is why this line is important, and then adds to it or subtracts from it various adjustments. Moving on, line 12A, standard deduction or itemized deduction. So without getting into too much detail, every taxpayer is entitled to take their what's called standard deduction. It's approximately $25,000 for a married couple, half of that for single folks, adjusts every year for inflation. If that is larger than what your itemizable deductions would be, you'd be better off taking standard deduction or vice versa. So Schedule A is what shows the various itemized deductions. You can help review or make sure the client is taking all of the deductions they are eligible to get. Deductions from medical expenses, only those in excess of 7.5% of adjusted gross income. State and local taxes, state income tax, property tax is a big one. Those are capped at $10,000, but are they utilizing all those to the fullest? Home mortgage interest, including points on new mortgages, that may be deductible. Donations. Doesn't need to be cash. Could be donating stuff, not time. Donating your time doesn't count, but could be donating stuff. Old clothes, cars, whatever. Driving for charitable causes. There's a mileage deduction for driving to do volunteer stuff, for example. If you add all those itemized deductions up, if they're larger than standard deduction, the client will be better itemizing deductions. So you can sort of spot check this for them. This probably won't last again, but for 2021, even if a client took standard deduction, they can still get a deduction for up to $600 of cash donations to qualified charities during the year. $600 if married, $300 if single. So if you happen to be reviewing a 2021 tax return, you see they took the standard deduction, you see there is no such extra amount here, ask them, did you make any cash donations? If they say yes, next question is how much? If they only donated $10, don't bother. If they donated the full 300, 600 or more, then it may possibly be worth considering an amendment, but depends what the cost of the amendment is. Because even $600, if the client's in, let's just say 10% effective tax rate, it's saving them $60 in tax. Chances are the cost of the amendment is going to exceed that. So this isn't a huge value add per se, but nonetheless worth spotting. Moving on down, this just sums up all the other, all the deductions you've had so far. Now this is your taxable income line 15. This is the number that gets run through the actual federal tax brackets. Scrolling down. Next line, line 16. This is the tax based on the taxable income we just saw in line 15. Again, this is straight out of the federal tax brackets and rates. Skipping over some stuff here. Line 17, if there are other taxes, namely this is just alternative minimum tax. This really only applies currently while we're in the Tax Cuts and Jobs Act, really only applies to people who have incentive stock options and exercise them during the year. That's one of the few instances where AMT may still come into play. Or this can also be repayment of Affordable Care Act tax credits. So if someone got too much subsidy paid in advance during the year because they've lowballed their income estimate they gave the government healthcare exchange, they may have to pay back some of the credits they got. That would show up in line 17 as well. And line 18 just nets those together. Motoring along, there's a handful of some other possible taxes here. Line 20, credits. These would be like foreign tax credit, common if clients have non-US stocks in a regular brokerage account and they pay dividends, you get a little bit of a tax credit for taxes paid to foreign jurisdictions there. Residential energy credits may apply if you get certain new windows, new appliances, add insulation to your house, et cetera, or qualified plug-in or electric vehicle credits. If a client or prospect is considering buying an pure electric or plug-in car, there may be some credits for them, worth bringing up because that can help reduce your tax bill in that year. So that there's some sums here. Going to other taxes, line 23. This would be additional for those who are still working. If they have high income, there's additional Medicare taxes they may need to pay above and beyond what they paid out of their paycheck. There's something called the net investment income tax, which is part of the funding for the Affordable Care Act. Long story short, if your gross income's over a certain level, there's an additional 3.8% flat tax that applies on any passive investment income, such as dividends, interest, capital gains, rental income. If that passive income is above and beyond, I think the threshold is $250,000 for married folks, gross income, and $200 gross income for single folks, I believe. So that's line 23, other taxes. Line 24, total tax. This is a bunch of subtotals and stuff from what we just looked at. This is a big one as well, total tax. Why is it big? Well, this isn't the final tax obligation yet, but this is what goes into what's called the safe harbor. And I spelled this out in the notes. I don't want to spend too much time and suck up too many minutes on it, but a very, very common question from retirees or new retirees is, I've always had taxes just withheld from my paycheck my whole life. I never had to think about paying taxes. Now they're in retirement. There's no paycheck anymore. There's no automatic, tax withholdings. Clients may need to, or likely need to put much more thought into how much tax am I going to owe for the year? How do I pay it? And when? Do I do withholdings for my IRA, for my Social Security, for my pension, or do I make cash estimated payments from my checking account or, ACH deposit? Read more in the notes about the safe harbor rule. Basically, where I'm going with this is to help avoid potential underpayment penalties. You can use something called the safe harbor, which basically says as long as you withhold or pay enough estimated tax this year to cover at least as much as what your total tax was last year, or covers 90% of what it's ultimately going to be this year, you won't be hit with any underpayment penalties, even if you still end up with a large remaining tax bill at tax return time. So that's line 24, total tax. Again, this is the one that feeds the safe harbor amount. So that's an important one. Okay, next, motoring along. Again, I summarize this more in the notes that you all have that I'll send out to you. Skipping over some stuff here, it may not apply. Some of these are education credits, child tax credits, again, for retirees, not likely. Earned income credit, also not likely, especially if you don't have earned income, which retirees often won't. Recovery rebate credit, this won't be around again this year, but if you happen to be reviewing a 2021 tax return, this was there are 3 rounds of stimulus money handed out to many people, many taxpayers. If they were eligible for these credits, just check to see that they actually got it. And if you want to go through the math of making sure they got the right amount, because these credits were phased out based on income, this is one easy thing to check for them in 2021 returns, just to see if in case it was missed accidentally. Line 31, amount from Schedule 3. Why is this here? Well, there's a few other tax credits that may help reduce the client's tax obligation. For example, fairly common one for those that are on Affordable Care Act insurance is, again, the subsidies that they can get. Recall I said before, if they got too much subsidies paid throughout the year because they underestimated the income figure they gave the government, they'll have to pay back some of those credits they got. Or vice versa, if their actual income at the end of the year ends up being lower than the estimate they gave the government throughout the year, then they'll get additional credits paid to them at tax return time. So that's one thing that would show up in line 31 here. Finally, line 33, total payments. This is the sum of all the withholdings that they made, if any, such as from paychecks, from IRA distributions, from pensions, from annuities, from Social Security, any estimated taxes that they paid during the year, any refunds from the prior year that they rolled over and applied to current year will show up there. And also the possible refundable, tax credits I just mentioned a few rows above would also show up here. So then basically all said and done, you compare the total tax obligation you had for the year with the total payments made. The difference is simply the refund the client will get or additional tax the client would owe. In George and Wheezy's case here, they only had about $5,800 of total tax payments made throughout the year, but their total tax obligation was $17,136. They were short, $11,000 or so. Notice here, this one is an easy spot to help people try to avoid in the future. Estimated tax penalty. Recall I said before, there's a possible underpayment penalty. If you don't withhold or pay enough tax throughout the year, you may be subject to a penalty. Now, penalty sounds harsh. It's really just interest. Any amount you didn't pay but should have, at least up to the safe harbor amount that I mentioned, there will be interest charged on it. Now, last year, the interest rates were relatively low. I think it was a 3% annualized interest is what the IRS charged on underpayments. This year, or currently, I think it's 6%. It's possible to go up again as rates keep rising, evidently. So if the client's only short, a few $100 or something, or, $2,000 of tax, let's say, the underpayment penalty is not going to be huge. It'll be tens of dollars. If you're short, in this case, $12,000, this can start to add up. This could be hundreds of dollars of underpayment penalty / interest. So point is, if you see this on a client's return or prospect's return, realize, oops, yep, they didn't pay or withhold enough tax last year. Planning opportunity, right? Can this be mitigated, reduced, or avoided this year? Was last year some freaky one-off thing where they had a big fat lump sum of income they weren't anticipating? Or, is last year's income going to be indicative of this year? If it is, make sure, help them figure out how to avoid or minimize this by making sure they pay more tax through withholdings or estimated payments. All right, so that's the 1040 itself. Some of these things are fed by other forms and schedules, which I'll go through quickly. Here's the Schedule 1. This is showing that $2,000 of net rental income. A lot of these things won't apply to most people. If they do, if you see something, dig into it. There could be boatloads of possible opportunities. In this case, this means, okay, boom, this person clearly has rental real estate, royalties, partnerships, whatever. Let me look into it more. There's another form down below I'll show you that details, in this case, George and Wheezy own a rental property. There could be planning opportunities there. Here's our Hsa deduction. Here's some of the adjustments, the deductions to income that I touched on. $3,000 Hsa deduction. This should stand out. Why only $3,000? I know as a single person, you can contribute at least, I forget what it was last year, $3,600 or $3,200 maybe, plus a catch up. If you're, is it 50 or 55? I forget, whatever. But the point is they're in their 60s, so it would apply. Or was it a family plan? Even worse, if it was a family plan, they could have contributed double the amounts I just mentioned. So let's look into this. Why was it only $3,000? Going down more, Schedule 3, this was the additional credits and payments. Here's just showing, this was the George and Wheezy, I'm assuming, are on Affordable Care Act insurance. They got additional credits for, because their income was lower than they anticipated throughout the year, so they got extra credits. This ACA credit thing is a hard one. If you're not familiar with it, it's complicated, but it's a great planning opportunity for clients who are on ACA insurance or considering it. There's lots of value you can unlock and add in helping them do some estimates on ACA credits and therefore helping them manage income some. Maybe take less IRA distribution than you were planning to keep income low to maximize credits. Conversions, hot topic, has been for a few years. A lot of you may recommend conversions for folks thinking you're saving future taxes, but it's not just the actual marginal tax rate that matters. You have to look at other stuff. By converting more, are they giving up potentially thousands of dollars of ACA credits they otherwise would have gotten? There's a lot of competing goals often when you're trying to do tax planning. So just be aware of the angles and you can definitely add some value to clients if you're aware of the things to talk about. Schedule B, this is further info behind the interest amounts. Like I said, the example I gave, they got $7,500 in interest from their Ally bank account. do the math. If interest was 1% last year on average, this means they had $750,000 of cash at Ally. Planning opportunity, is that too much? Even if they're super conservative, holding that much cash could be a drag for them. Or is it all in one account, right? Are they blowing way past the $250,000 FDIC insurance limit? Or if there's an account held in trust name, then maybe they're okay. If there's at least multiple beneficiaries, that gets higher FDIC limits for that account. Other things, there's 2 other accounts with a pittance of interest. What are these? If this is your client, you probably already know about it. If this is a prospect, you see this, good discussion point. Hey, why do you have these 2 rando bank accounts? What are they for? Maybe they're just I don't know, I had it 20 years ago, never got rid of it. Help them clean it up, help them streamline, right? Or if there's a reason for it, then at least you can find out what that reason is. Maybe it's because this is actually money I want to earmark for my child or something, and it's important to me to have it. And there you go. You can just glean some more info about the client that way. Dividends, I sort of touched on before. If it's a client, you probably already know all this stuff because you're presumably managing their accounts. If you're not managing all of it, you can at least gain some access or some info about accounts held away. If they have multiple accounts, another decision, talking point, hey, why do you have multiple brokerage accounts? Consider consolidating if it makes sense. Capital gains and losses, just scrolling down, this summarizes short-term activity for the year. This summarizes long-term activity. Here's where capital gain distributions show up. This was a big one, especially last year. If you see a large number here, this means the client has sizable amounts of mutual funds, probably actively managed mutual funds, not necessarily, but last year Vanguard passive funds got zonked for specific reasons. But if you see a large amount here, this can mean the client's not very tax efficient with their asset location. They have too many mutual funds in a regular taxable brokerage account. See if you can help diversify, optimize, the taxation of stuff for them. The 8949, anytime there's individual sales of securities, each sale should show up here. Or if you do a lot, you can just sort of lump them together. Various short-term trades. Point is, maybe you can, especially for prospects, you can possibly see some info about accounts they have, trading activity, what type of stuff they're holding, et cetera, by looking at this. But if the prospect's close enough that you get their tax return, chances are you would have got their brokerage statements anyway. So maybe you'd already have that information at your fingertips. Here's in George and Wheezy's case, they own the dry cleaner that George used to own. They now own the building and rent it out. A lot of stuff going on here. Unless you're comfortable with rentals and what goes into it, don't try to be a hero here necessarily. But if you know the basics, you can help them make sure that they are deducting all the expenses you're eligible to deduct, especially depreciation. Whether or not they actually deduct depreciation, they will have to realize it as income when they do eventually sell the place. So make sure they're getting the tax benefit along the way of actually deducting it, because they're going to have to pay for it anyway when they quote unquote recapture it, if and when they eventually sell it. 8606, this is a big one for anyone with basis after tax contributions in any IRAs. I don't want to spend up too much time here. I want to be respectful of all of your time, get you out by 3 o'clock Eastern. But this is the form that calculates the pro rata rule. Quickly, this is the value of all IRAs as of December 31st of that year, planning opportunity. Regardless when in the year you do a conversion or distribution, it's the December 31st value of your IRAs that gets factored into this pro rata rule. Planning opportunity. If client has access to an employer-based non-IRA savings plan like a 401k, and it allows in rollovers from IRAs, the client can, in effect, break apart their pre-tax and after-tax money in their IRAs. They can roll the pre-tax money into the 401k, leaving behind just the already taxed basis in their account, then convert that, distribute that, et cetera, tax-free. Pro rata rule will not apply. Anyway, you can see the math here. This is what's saying, it's saying 1.66% of all IRA balances are basis. Therefore, the remaining, whatever that is, 92% and change is all going to be taxable. 1.66% will not. In this case, they did a conversion. Wheezy did a conversion this year for $100,000. She had some basis in her account. So $98,000 of her conversion was taxable. $1,700 was not. This is what flows into that gross and taxable amount of IRAs in the tax return. HSA form, as I mentioned, if you see they under-contributed, find out why. They could have contributed much more. If you see deductions, if you see distributions from their account, even if they were qualified, and not taxable, you may bring up, hey, HSA is one of the most tax advantage accounts there are. It might be worth not using it right now to pay yourself back. Let it sit, let it bake, let it invest and grow. Use it down the road, later in life. Premium tax credit. This is the form that reconciles the ACA credits. Again, fairly technical if you're not used to it. If you do want to get kind of in the weeds with tax planning, this again could add a lot of value to clients by being familiar with ACA credits and how to help clients navigate them. All right, that's it. And that's my notes. This is mostly what I talked about today. I threw in some sidebars, but otherwise, this sums up everything we just talked about. Again, I will email it to you all after this. Questions? All right, let me stop my screen share. Not sure the best way to do this. Q&A. Just looking if anyone has questions here. I'm just scrolling. Hi, Andy. Hi, Andy. I assume we'll be able to get a replay of this webinar. Yes, anonymous attendee asks, can we get a replay? I will save it up on my YouTube channel after the fact. You can find my YouTube channel on the About Andy section of the handout I will give you. But spoiler alert, it is Retirement Planning Demystified. Eric asked the same. Will the recording be available? All right, here's, does everybody show questions? This is my first time doing webinars. Does everybody show questions on the screen? Let's see, what does answer live mean? Okay, anyway, anonymous attendee asks, if a spouse dies, can the surviving spouse sell their home and still take advantage of the joint cap for profit on the sale? For example, Jane dies and John sells the house and realizes $400,000 profit. Will John have to pay cap gains on $150,000? Or I know where you're going with this. So yes, you probably all know when you have a primary residence that you sell for a gain, if you owned and lived in it as your primary residence for at least 2 out of the last 5 years up to the date of the sale, married couples can exclude $500,000 a gain. Single folks can exclude $250,000. Question is, what happens if you die? So married couple live in a house. It's highly appreciated. Spouse dies in June, let's say. Can the surviving spouse still claim the larger $500,000 married gain exclusion, or is the surviving spouse limited to $250,000? Thankfully, the surviving spouse can still do $500,000 up to 2 years after the date of the death of the spouse who died. So even in future years, remember I said you can file a joint return in the year of death. After that, you have to file single unless you remarry. Even if you file single the next year and you sell the house, you can still use the $500,000 gain exclusion because you have 2 years from the date of death to use that married exclusion. Good question, anonymous. Chris Randall says, except in Illinois, many times Illinois municipal bonds are taxable at the state level. Good to know. Fun fact about states. I mentioned this topic today is about federal, not state, because states are a lot going on. A lot of states have retirement income exclusions. New Jersey, for example, notoriously high tax state, does have a fairly generous retirement income exclusion. Illinois, for example, excludes all retirement income, pensions, IRAs, including conversions. I think you have to be over 60 to get that, but still. What else? New York has a bit of an exclusion, $20,000 per spouse. Many states have things like that. So this can come up, and I had this last year. If you have a married couple, one or both want to do some conversions, look at the retirement income exclusion. Which one has, at the state level, which one has more capacity there? Maybe that'll help guide your hand as to which spouse does a conversion to help reduce taxes, at least at the state level. So there's always little nooks and crannies of tax planning opportunities here. Nick Convoy asks, so line 9, is total income your Maggie? No, Maggie starts with line 11, adjusted gross income. Add or subtract from that various other things, which are summarized in that handout on my free resources section that you all have the link to. Darren Doty asks, can you take an additional $600 charitable donation with both standard and itemized deductions? No, great question. For 2021, I mentioned married couples can get an additional $600,000 of deductions for cash. It's got to be cash, charitable donations, even on top of the standard deduction. That does not apply on top of itemized deductions. So if your itemized deductions are well under your standard and adding $600 to it won't matter, it's not going to matter. But anyway, no, you can't take the itemized and the extra 600, Darren. Anonymous attendee asks, what is your process for quantifying whether a new client is withholding the right amount once you get their W-2? Man, that's a tough one. Great question. There's no way to do it without getting in the weeds with doing a projection like this, whether you have tax return projection software or there's free online calculators like Dinkytown has a Excel-based calculator. You can use software like TurboTax, or the IRS has a withholdings and estimated tax calculator. You can go there. There's no easy way to do it without going through the homework of knowing all their income, their credits, their other sources of withholdings or estimated taxes, if any. that will then tell you for the year, what their total tax is and what the shortfall is of their withholdings or estimated payments. So not a simple answer, but there really is no shortcut to do this, unfortunately, barring software or online forms like the IRS one. There's a question here from anonymous attendee. For the safe harbor rule, say 2021 tax equals $100. For high earners needing 110% to meet the rule, they need 110 of tax withheld in 2022 to avoid underpayment penalties. Correct. Even if they have tons of taxes owed in 2022 come tax time derived from other income. That's correct. So the safe harbor, one extreme, let's assume last year their total tax was $0. This year they have $10 million of taxable income from whatever, it doesn't matter. They're going to ultimately owe tax on $10 million. Let's assume that's $350,000 federal tax. They can pay or withhold nothing throughout the year and just pay all $350,000 at tax return time. They will not be hit with any underpayment penalty, even though they're $350,000 short. Because of the safe harbor, they have to withhold at least 110% of last year's total tax. Last year's total tax was $0. 110% is $0. So that's their safe harbor for the year, $0. Great question. Andy Fisher asks, what tax software do you use? How do you estimate the time it takes and what you will charge a prepare return? I use something called Drake Tax. There's a bunch of commercial software available. Drake is good. I'm a relatively small preparer. I don't want my tax business to get carried away. Estimate time it takes. I charge flat rates for my tax returns, a little more. I mean, I turn away complex returns, but a little more based on certain complexity adjustments, but not to get too in the weeds. You can find out more on my tax return website. There's a link to on my about info. Cody Garrett, if you'd like to provide additional clarity, line 3A, qualified dividends are also included in 3B, the ordinary dividend amount. That's correct, Cody. 3B, the tax return is total of qualified plus non-qualified dividends. Did not mention that before. He also mentioned line 13, qualified business income deduction. If you see that may mean the client has some REITs, REIT, real estate investment trust, and a brokerage account. I did actually mention that in the notes. Thanks for bringing that up, though, Cody. Brian Boswell asked, regarding HSAs, when would you recommend not deferring the savings in the account? I don't know. I mean, if the client's really hard up for cash flow, then yeah, if $3,000 or $4,000 is really going to put a crimp in their day to day, then don't. But otherwise, or if they're really, no, this wouldn't count. I was going to say if they're really close to end of life, they don't have a lot more time to let the HSA grow. But if they're that old, chances are they're already on Medicare, in which case they're not eligible to contribute to an HSA anyway, because having Medicare is not an eligible health insurance type. Generally speaking, I'd say take advantage of it. A, because it gives you a deduction. B, because again, it's the most tax favored vehicle there is. Tax deduction on the way in, tax-free earnings along the way, and tax-free distributions, assuming you use it to pay qualified medical expenses. So trifecta. And for those who are working and have an HSA through their work, the fourth tax benefit is if you make contributions through your work, it's usually also saves you FICA taxes, the payroll taxes. That amount of contribution won't be included in your gross income for purposes of how much Social Security, Medicare tax you have to pay, generally. Bruce Lawrence asks, if line 4B is lower than 4A, that was the IRA line, where 4B was taxable, 4A is gross. Another reason could be they've done qualified charitable distributions, although they should show QCD by the amount to indicate that they've done that correct. Yes, great comment, Bruce. I do have that in the notes about QCDs. So qualified charitable distribution is anyone who's 70 and a half or older can make charitable distributions straight away out of their IRAs to qualifying charities. When you do that, it still shows up as a gross distribution on a 1099-R. The onus is on the client to know some or all of that distribution was a qualified charitable distribution. If it is, that's exempt from taxes. So that would be one possible reason why the taxable amount of IRA distributions could and should be lower than the gross amount. But again, onus is on the client to know that, or you as the advisor, if you know the client did QCDs, help remind them. And this was also in the notes that you all get. If a client is 70 and a half and older and charitably inclined, and they're making cash donations, they should almost always do QCDs instead of cash donations. Because not only does it save tax, just the same as cash donations does, but QCDs are not included in their gross income. Therefore, it's not included in the various MAGIs that affect other things like Medicare premium surcharges, ACA credits, net investment income tax thresholds, et cetera. Great comment, Bruce. Great observation. Anonymous attendee, are you of the opinion that having at least $3,000 of capital gain or loss, if losses can be harvested, is useful to offset the higher ordinary income tax rates each year? Yes. So question is, if the client does have realized capital gain losses that couldn't be deducted in prior years, should you soak up those losses against selling other things at a gain, or let it just sit there and offset other income? From a tax perspective, it's better to let it offset other income, or at least offset short-term capital gains. Because if you have a realized long-term capital gain, it's going to be taxed at a reduced rate federally, at least. States are different, but a reduced rate federally, as opposed to what a short-term capital gain will be taxed at, or even other income. So all else equal, you'd rather the $3,000 offset short-term capital gains or other income than be used to soak up long-term capital gains. Now, you may not have a choice. For example, if the client is stuffed with a bunch of capital gain distributions, like a lot of people were in 2021, you can't stop that unless the client consciously sold out of those funds before they got the distributions. But that's considered long-term. So if the client gets those long-term capital gains from mutual fund distributions, that their carried over losses are going to have to be used to soak that up. You can't stop it, unfortunately. Justin Pritchard, any oversimplified tips or dollar amounts for the competing goals of taking income early or converting it versus minimizing income for health coverage costs, both before and after Medicare? Man, no. Awesome question. And I struggle with this a lot in practice with my clients, competing goals. I have one client that has really sizable tax deferred balances, but is a few years away from Medicare and is able, because of the state they live in and the cost of policies there, they can get some really, really generous ACA subsidies, even with $160,000 of gross income, which is, that came to mind because that's their number for this year. So it's tough. At one extreme, you'd be like, you got a few $1 million of tax deferred IRA. We got to start working on it. Let's skip the ACA credits and do conversions or do distributions now to recognize some of that income and taxes now. On the other hand, they'd be giving up literally thousands of dollars. I forget the amount. I want to say it was like 15 grand plus of ACA credits are getting. Bird in the hand is worth two in the bush. That's tough pill to swallow, whatever. To give up, 15 grand of ACA credits for the benefit of hoping conversions or distributions now will save you that much more down the road. Maybe it will, maybe it won't. I don't know. None of us have a crystal ball that works, but there are competing goals that you can't possibly quantify because a lot of it's future guessing. Mackenzie Blakesley asks, how is crypto currently taxed, or is it taxed at all? It is definitely taxed. That's why the IRS is cracking down, because people don't think it's taxed, or they know it's taxed and know the IRS has a hard time getting info about it, so they don't say anything. Crypto is an asset, just like any other asset. If you hold it more than a year before you sell it at a gain, that gain is a long-term capital gain you have to report. If you hold it for less than a year, sell it at a gain, it's a short-term gain you have to report. If you sell it at a loss, it's a realized loss, just like selling a stock or a bond at a loss is in a regular brokerage account. So yes, it's definitely taxed. You have to report it. The reporting from the crypto custodians is spotty at best. So this is why it's such a quagmire and nightmare to try to get this info. And I try to not work with people who have crypto transactions simply for that, at least from a tax return business perspective. But yeah, it's definitely taxed. Great question. Megan Abbott, what are the key forms to check for carryover losses? Is it Schedule D? I think Schedule D of the tax return shows it. If not, that's a good question. I don't know that. Just looking at Schedule D quickly here. Yeah, it does. Okay. So Schedule D for both short-term and long-term, it does show carried over losses from prior years. So you can see it there, Megan. Brian Remsen says, seeing a lot of missed QCDs by preparers. Are you seeing the same? Yeah, because preparer is never going to know about it. Again, the onus is on the client to know the QCD was done and to inform the tax return preparer that it was done. Otherwise, there's no special designation on the 1099-R that says QCD. It's going to show it gross distribution just the same. So that's why it's commonly missed. As the advisor, as a planner, if you're aware of that, make sure you discuss that with the client. Jason, what time we got? Okay, we've got another minute here. Again, I want to be careful of your time. I'm happy to stick around for a bit. Anyone else who needs to jump in the next minute, feel free. There's 78 questions. Not getting to all of them, but I will stick around another until my voice starts running out. I got call it 15 minutes perhaps. Then we'll wrap it up there and we'll see how far we can get. Jason Ramage asks, 2 for you. Some of the situations we might see that indicate married filing separately might be more beneficial for married filing joint. Where will I bond interest show after redemption? So the married filing joint versus separate thing, again, from a pure dollars and cents, separate's rarely better. There's some exceptions, like for example, if there's a married couple and one has a lot of student loan debt, who can get some or all of it forgiven or at least deferred based on income, then it may be better to file separately. So that spouse, if that spouse has low income, that spouse can show low income. Whereas if the other spouse has large income, you don't want those two combined from a married perspective because that may impact the student loan interest or repayment. That's one example. Another is like if you're about to go through a divorce, you want to start keeping your stuff separate, or if your spouse is off the rails with not paying taxes, you don't want to be held responsible for his or her tax obligations because he's crazy. You can file separately, and therefore you'll only be obligated for your own tax obligation, not your spouse's. That's another example. Where will I bond interest show after redeeming it? It should be in the interest. That's a good question. I-bonds are they've been around a long time, but people using them in mass are relatively new since interest rates have been high in the last year or so. So I haven't seen one redeemed yet, to be honest. I think it should go in the interest section because that's where I think Treasury bond interest goes. Yeah, it should be an interest section. You'll get a 1099 from the Department of Treasury showing it, but I think that's where it goes. Not 100% certain. Michael Stokvis asks, have you ever run a calculation on drawing funds from HSA today or paying out of pocket and then getting reimbursed down the road? I can make the results of that projection look like whatever I want it to look like. That's the problem with a lot of these tax projections, such as, do I do Roth conversions or not? If so, how much? So much of the ultimate benefit, if any, relies on unknowns, future unknowns that are tremendously important that we can't estimate. How tax legislation will change, how the financial market returns will happen, meaning, the money invested in the HSA or Roth IRA, how high up will it go or go down, go up or go down. Clients on longevity, are they going to die before they get to realize any benefit from this stuff, et cetera? We don't know the answers to these things. So the best you can do is make some educated guesses, discuss pros and cons with the client, tell them, this action will work if these scenarios play themselves out, or this action will be better if these other scenarios play themselves out, and just collectively make a conscious choice. I'm reluctant to put quantitative projections in front of clients like value of Roth conversions. If you're doing a 30-year income and tax projection, you're kidding yourself. You think it's going to be right. Hopefully it will be, but it will be wrong. It's just a matter of wrong to what extent. Will it be wrong on the high side and the downside? Some things we know for sure, tax rates are due to go up in 2026, if not sooner, as the Tax Cuts and Jobs Act expires. But even that is subject to change. Tax legislation can always change. Anyway, long way of saying no. I think you're sort of splitting hairs when you try to, not to say tax return or financial planning software won't do projections for you about Roth conversions or take HSA distributions or not. But just keep in mind, there's a lot of educated guessing even behind the software and its assumptions. So don't get too hung up on seeing a number and thinking, that's gold or that's definitely going to play itself out. James Mahaney asks, although you didn't get into it, do you ever look at W-2s? And if so, where do you focus? Yeah, one thing I sort of mentioned was like a W2 won't, never mind. Yes, W2 will show things like HSA contributions made. It'll show, because you can't double dip. So if you can do, I forget the number again, 40, whatever this year's limit is, 4,600 if you're old enough, of HSA contributions. Well, if you contribute 3,000 through work, you can't do another 4,600 directly. In total, it can only be 46. So you can see things like that in a W-2. Again, you can also see the amount that the employer paid for the employee's health insurance premiums. That was one of the things I said you can use to help figure out what the client's COBRA cost will be if they choose to use COBRA insurance. Looking at tax withholdings, see how much tax they withheld can also help. So there's a lot of stuff going on in W-2s, RSUs. If they have stock compensation, you get some info about that. Becky Schuster asks, is there a good way to remember what goes into Maggie? That summary on 10infinancial.com/free-resources, there is a freely downloadable summary of the few different Maggies that are common in retirement planning. It's not all of them. There's at least a dozen Maggies I'm aware of throughout the tax code, more than that even. These are just the 5 or 6 I picked that you're most likely to see in as a retirement planner. So that's a really good cheat sheet. That's not comprehensive. You'll see a footnote there. There are some other things that go into those, but it's off the beaten path things that rarely apply, like typically foreign tax credits and other foreign deductions clients get. You have to add those back into almost all those Maggies. But I've yet to see one client that actually has those things. Now, if you work with international folks, very different story. But for people who don't really have any international angles to their lives, the Maggie summary on my website should cover everything, or close to it at least. Kintara Costa asked, will HSA be broken out if done directly on payroll or simply subtracted from wages line? So the box 1 of the W-2 will show the client's net taxable wages. That will be after deductions for 401k, tax deferred 401k contributions, for example, and HSA contributions, for example. Separately, in box 14, I think is of the W-2, that's where it will show total HSA contributions that were made through the employer for that year. So that information is definitely there. Michael Demke asked, do you use any additional tax planning software like Hsa? Do you have any thoughts on Hsa or others? Interesting question. Yes, I have a Hsa. No, I don't really use it. Not to say it's not a good product. I just got it like a month ago, and I ran this return through it, and it didn't spot anything I didn't already pick up on. So if you're not already comfortable and familiar with the process of reviewing a tax return, if you don't already conditioned to think about the things to look for, something like Hsa is very valuable. It'll give you some helpful hints and point things out and show you Maggie ranges and stuff like that. So can be very valuable. In my case, or anyone else who's already very comfortable with reviewing tax returns and knows the things to look for, not really necessary. Now, what my process doesn't do that Hsa does, it makes a pretty little report you can print out and give to clients. So if you or clients want that report, then sure, even if you are good at reviewing tax returns, maybe Hsa is worth it. But I have mixed feelings in my scenario, but I can see how it can be very valuable for lots of folks. Anonymous attendee asks, what if the client is not retired and receives a large amount from a business venture, such as a distribution from a company they own? Where would you see that on this tax form? It depends on what form it is. If it's a business they sold, it would show up on, I think, Schedule D, and there'll be a form 4797 attached to it. It'll be sale of other property, I think it is. If it's a business that they're a partnership in and the partnership sold something and passed through the gain to his partners, then they'll get a K1 showing that. And that K1 should get reported on Schedule E, I think, and that will in turn flow into Schedule 1, which flows into the 1040. So ultimately, it could show up in a lot of places or different places, depending on what exactly the scenario is. Justin Pritchard, do you find that clients are in lower or higher tax brackets than they expected in retirement, and how does that change once RMDs start? It really depends. Like, you can't be dogmatic about anything in this industry. There's some folks who toot the horn all day long. The end is near, tax rates are going to double. Do conversions, buy this product, whatever. Maybe it will, maybe it won't. I mean, not to say tax rates themselves won't double, but that doesn't mean the client's actual tax scenario won't be better. If someone's making $500,000 a year in wages now, and those wages go away upon retirement, chances are they're probably in a lower tax scenario in retirement, even if there are higher tax brackets. So it really all depends. To answer your question, Justin, I've seen both. Some clients are in a better situation, lower tax than when they're working. Others are vice versa, especially when RMDs start. If you have sizable tax deferred balances, especially when Social Security kicks in, pension kicks in, RMDs, and for married couples, if when one spouse dies and the surviving spouse now has to file a single, tax brackets compress, they collapse, they get cut in half. So all else equal, the surviving spouse will have a higher tax scenario than they did when they were married in many cases. So that's one thing to consider. Anonymous attendee asks, how are alimony payments and child support treated at the federal level? How does it impact AGI, Maggie, et cetera? So child support is never taxable to the recipient and not tax deductible to the payer. Alimony depends. Alimony, if it's from a divorce decree that was signed, I think pre-2019 or maybe 2018, I can be wrong. But if it's a divorce decree that was executed prior to then the alimony paid is taxable to the recipient and tax deductible to the payer. If it's alimony from a divorce decree signed after that date,
So starting in 2019 or maybe 2018, I could be off by the year. The alimony is not taxable to the recipient and not deductible to the payer. If it is taxable, it shows up as other income on Schedule 1. If it's tax deductible, same thing. It's on Schedule 1 for the payer as alimony paid. So it does impact AGI and MAGI just the same. Pound for pound, $10,000 of taxable alimony from a pre-2018 divorce is $10,000 of extra AGI, which is $10,000 of extra MAGI, depending on what MAGI you're looking at. So it definitely comes into play, again, for divorce decrees signed pre-2019 or maybe pre-2018. I forget the year. Anonymous attendee asks, are you gathering returns in the prospecting phase or after when they are actual clients? So I'm done growing my advisory business. I'm not taking any more clients. I'm at capacity and happy with that. In my prospect process before I was filled up, I would not ask for these documents from prospects, not tax returns at least. I mean, sometimes clients will want to send me things to look at, in which case, sure. But I would just verbally talk through everyone. I do an hour-long intro with all new prospects. Sometimes, in the first 10 minutes, it's not going to work for whatever reason, and we go our separate ways. But otherwise, I would generally talk for an hour with everyone. And in that, I would get probably like 90% of what I need to know about them just from that conversation without getting statements and stuff. But once they're clients, definitely, I do ask for tax returns from all clients. Full stop. It's never not been asked, and nor would I. If a client was ever reluctant to give it to me, huge red warning sign. We'd potentially part ways depending what the reason was for not wanting to show it to me. Daniela Sarasani asked, can you review where to determine if a client is a candidate for a Roth conversion? No, unfortunately. I sort of touched on it before, but there's way too many things that go into deciding whether or not conversions are beneficial for someone, and if so, how much. You can sort of start by using financial planning software, do some projections, but like I said, projections are fatally flawed to start with, and that there's so many assumptions that go into it, where those variables and those assumptions will be different over time than what we assume they are today. Sometimes it's obvious. If a client has $3 million IRA, pre-tax IRA, they retired at 60, they have no other income for now. They didn't start Social Security, there's no pension, their wages stopped. They have zero taxable income for the year. Let's assume they have a stockpile of cash. They should not be living off cash. They should be getting ahead of that $3 million of IRA that will all eventually be taxable at some point, if at no other time than when RMDs start at age 72. Whether they do distributions to pull out and recognize some of that income or conversions, they have to be pulling out some money, at least to fill up 12% tax bracket, probably more, because with $3 million tax deferred money, they're going to have chunky amounts of tax in the future. Get ahead of it now. But I can't quantify how much is the right amount to do. Just like, don't let your tax bracket be zero in a situation like that. Make sure you're consciously filling it up to take advantage of it while we can. Tan Fan, how are you seeing clients using AMT credits after exercising ISOs? Not yet so. I only have one client where this is an issue, and she hasn't yet. It's been 2 years of exercising ISOs and not selling the underlying shares, so she hasn't yet realized the benefit of these AMT tax credits she can pay going forward. But the intention is they will help when she stops exercising ISOs, the AMT taxes she paid, those credits will help reduce her tax bill going forward. Jonathan Brummel, what is the most material error you found and are able to add value with? In my case, I'm trying to think. You stumped me. The one I mentioned before, which wasn't huge, but the clients whose tax preparer missed reporting muni interest as tax-free, that saved $600. I don't deal with exceptionally complex clients, and that's intentional. So I don't touch people with businesses or tens of millions of dollars in net worth or international matters. So most of my clients are fairly vanilla. Some have small side hustles, some have rental properties, but I've yet to find any glaringly big, like, man, this was $50,000 of savings for you. Hasn't happened yet. Not to say it won't at some point, but hasn't happened. No, but they've all been fairly modest so far. I've definitely found errors. Again, some of them aren't worth amending because the cost of amendment is going to be more than the tax benefit. And again, errors happen. Even the best of preparers will make errors at some point. Just if they're big enough, help people fix them. Question about software I use. I already answered that. Quentin Smith, can we get on an email list to notify us of future events like this? Maybe. Quentin, I don't know what I'm doing with this. I don't know what my intention is, for example. Like I said, I'm just doing this for the fun of it because I enjoy teaching. Maybe I like hearing myself talk. And I think this is tremendously valuable stuff that I know I'm fairly good at and do in practice. So I wanted to share with advisors because I know tax planning is something a lot of folks don't do or can't do, depending on the firm you work at. Or maybe you want to start doing it, but don't know where to start. So I'm just trying to share. I frankly have nothing on the docket for other webinars going forward, but if and when I do, I'm not sure. I promise to not use everyone's email for lead capture or marketing. So with that in mind, I reluctant to send you all an email. I'll probably just blast it on LinkedIn and Facebook again, like I did for this one. But anyway, nothing's on the calendar yet. Charlie Pastor, do you already have a video webinar on ACA credits? If not, would you consider recording one? Do I? I think I have a podcast episode on it. I don't know that I did do a video actually. Yeah. If you go on my YouTube channel, Retirement Planning Demystified, again, there'll be a link in this thing I'll send you afterward. There's a video there that was a previous recording of a live video I did in my Facebook group a year or two back. So there's that. And I'm pretty sure I did an episode of my podcast, but I'm not certain. So you can check there. Molly Stanifer, HSA contributions done through payroll will only be showed on their W-2, correct? It'll be showed on their pay stubs as well. End of your pay stub, it'll show contributions for the year. But yes, W-2 will show the amount they contributed. Mark Stevens, do you make efforts to partner with tax professionals as a Series 65 licensed refers to participate in an ongoing IAR review? Do you find value in leveraging tax pros as centers of influence? I don't partner, Matt. I mean, I do tax returns myself. I know taxes fairly well, so I'm confident in my abilities. Not that I know everything, obviously, but I'm confident in my abilities. If I ever come across something hairy, then sure, I'll reach out to folks, and I have at some point. I have a network of other tax folks that I occasionally reach out to. But otherwise, no, I have nothing formal in place, and I'm not looking for additional clients or anything. So I'm not interested in referral sources. So I'm not interested in centers of influence for that reason. J.R. Robinson, what are your thoughts about rental property and depreciation? Everyone seems to think that rental properties are a great tax savings vehicle, but depreciation recapture seems to me to negate most of that benefit. What is your opinion on rental property from a tax perspective? 100% agree, JR. Not everyone, but a lot of people are like, oh man, rentals are great. You can depreciate, you can get an expense deduction for the non-cash expense of depreciation. Yay. Well, you can, but there's no free lunch. When I touched on it before, all the depreciation you expense throughout the years or should have expense, even if you didn't actually expense it, when you sell the place, you generally have to not pay it back, but you have to pay ordinary income tax on all the amount of depreciation you expensed or should have expensed. Now, the ordinary tax rate caps at 25% for that reason, in that scenario. But yeah, it's not that great of a tax benefit, these rental things, JR, unless someone's manipulative and is running a lot of fake expenses to the rental, but you shouldn't be doing that. But outside of that, no, rentals are far from this tremendous tax thing. Now, with that rental depreciation recapture, what you can do is there's a few things. I mean, you can roll it to a 1031 exchange, but I only do that if you want to still be a landlord. Don't do that just to try to keep punting the ball on taxes. If you plan on bequeathing this property to your heirs, you can get a step up in basis. Included in that step up is all the depreciation recapture magically goes away along with any gains on the place, so that whoever inherits it gets it scot-free with a new basis from when you die. So that's one opportunity. But outside of that, yeah, if and when you're eventually going to sell the place, this depreciation recapture bites you in the hiney, and you'll realize, man, this rental wasn't as good as I thought it was from a tax perspective. All right, let's wrap soon. What else do we have? A couple more people asked about projections. Okay. I guess there's still plenty of questions. Sorry, I'm not getting to all these. All right, we will stop it there. Hope you all found this productive. Again, I didn't know what to expect, so sorry if I may have rambled a bit. Hopefully this was what you were hoping and thinking it would be. Hopefully you found it valuable. I do not have any sort of follow-up. There's no Q&A. There's no survey. Again, I just genuinely hope that you enjoyed this and got something out of it. As I said, I will be emailing you all the info packet that I went through. I will not use your names or emails to solicit anything. This is just freely giving you this stuff. Hope you enjoy it. That's that. Cool. I had a blast. Hope you did as well. Hope you got a lot out of it. And if and when I do one of these again, I'll be sure to let the social media world know at least.
and maybe we'll cross paths some other time. That's that. Take care, all. Thanks for joining.